Protesters across the country have been showing up to Tesla dealerships and showrooms, unhappy with Elon Musk and the government cuts made through the Department of Government Efficiency.
Tesla is in trouble. What was once the golden child of the EV revolution is now facing a perfect storm. Plummeting stock prices, nosediving sales, and a growing wave of global protests targeting Elon Musk himself. From Wall Street panic to anti-Elon demonstrations erupting in major cities, the pressure is mounting like never before. Is this the beginning of the end for Tesla's reign, or just another bump in the road for the controversial tech giant? Buckle up, because this crash might be more than just financial. The looming impact of Trump's proposed tariffs has cast a cloud over many sectors, and Tesla is feeling the heat directly. As the U.S. government considers new tariffs, especially those targeting industries like copper and electric vehicles, Tesla's global operations face rising costs and increased uncertainty. The electric vehicle giant has built its strategy around global supply chains and international incentives. But with new trade barriers and geopolitical drama creeping in, Tesla finds itself in the crosshairs of policy shifts it can't control. Investors are watching closely to see how this plays out, especially with Tesla being a top holding in several ARK Invest ETFs. One immediate blow came from Canada, where the government froze $43 million in electric vehicle rebates tied to Tesla and has excluded the company from future subsidy programs. That move appears to be directly linked to tensions stemming from U.S. tariff policies, showing how these trade measures can ripple outward and hurt Tesla's bottom line fast. Without those incentives, Canadian demand for Teslas could dip, squeezing margins and slowing growth in a key market. This shift could also send a signal to other countries that have been generous with EV subsidies. If geopolitical games are going to disrupt the market, they might follow suit. The recent macroeconomic headwinds have affected Tesla stock very less, with a recent solid rally, mainly due to optimistic sentiment held around the tech sector. But do not get too comfortable. Some analysts warn that the rally may be short-lived if the authorities stiffen their stance on tariff policies or if the upcoming delivery report from Tesla disappoints. Tariffs have an impact on demand, but they also create an increase in the costs of raw materials like copper and lithium, which are highly important for battery production at Tesla. If an increase in those costs occurs, Tesla will simply ripple them over to consumers, which will ultimately raise the pricing of Teslas and render them less competitive against rivals like BYD. In the context of tariffs, further with the premise of uncertainty, it tends to add another layer of disturbances along the already unstable path of Tesla. Shifting regulations, international backlash, and supply chain disruptions will together necessitate a rigorous reconciliation of the company's ambitious expansion plan. Moreover, with the delivery date and other economic reports coming in early April, not only could Tesla become at the mercy of the markets, but political forces would also intervene beyond their control. Yet behind the stock charts and supply chain stress, a new layer of drama is unfolding, one that's got Elon playing both sides. Tesla sounds the alarm. In a letter to U.S. Trade Representative Jamieson Greer, the EV giant emphasized that American exporters are uniquely vulnerable when foreign governments retaliate against U.S. trade actions. Tesla's concerns are far from hypothetical. Previous rounds of U.S.-led tariffs have already triggered tit-for-tat measures abroad, particularly aimed at electric vehicles, creating turbulence in Tesla's international markets. This warning from Tesla comes at a particularly awkward moment, as Musk himself has become an outspoken supporter of Trump, despite their previously opposing stances on issues like climate and clean energy. Their alliance, forged during the 2024 election cycle, is raising eyebrows, especially now that Musk's company is directly calling out the very administration it's aligned with. The tension highlights how political loyalty and economic reality can clash hard when policy decisions start hitting the bottom line. Tesla's attempt to toe the line between support and self-preservation is walking a fine line, and investors are taking notice. Also, with the letter issued by Tesla, a critical operational issue has been thrown into the limelight. Even with the source of production in substantial numbers within the nation, the company is still largely dependent on a portion of items such as lithium-ion batteries, which are not readily available in the U.S. Any new barriers or tariff restrictions on imports on these parts would make production expensive and make Tesla uncompetitive. It urged the U.S. Trade Office to consider the tangling complexities with respect to supply chains before any blanket tariffs are imposed. In simpler terms, if you really want to make American manufacturing better and boost it, you shouldn't make it harder for American businesses to get the stuff they need to do so. At the end of the day, this isn't really about Tesla's business. It goes beyond that, warning of things to come. The coal mine canary that says how trade wars turn into boomerangs in the home. If key partners decide to retaliate once again, really Europe or Canada, new taxes, slower sales, and even more headaches are going to face Tesla in global markets. And now that Musk is the head of the new Department of Government Efficiency, no one misses the ironic bit about Tesla being caught up in government inefficiency and red tape. Whether this letter changes minds in DC remains to be seen. However, one thing is for sure. Tesla is not going to keep quiet while the tariff storm brews. While Musk sounds the alarm on tariffs, Tesla's biggest threat may be rolling up right beside it on the highway. Tesla, once the unchallenged leader in the electric vehicle (EV) market, now faces significant market challenges that are testing its dominance. Despite a recent 12% jump in stock price leading a broader tech rally, as reported on March 24, 2025, by Stephen Wisniewski in the Wall Street Journal, the company has been under pressure from various angles. The automotive landscape has dramatically shifted, with traditional giants like Volkswagen, General Motors, and Ford intensifying their efforts in the EV space. These companies leverage decades of manufacturing expertise and substantial financial resources to diversify their EV offerings, which appeal to different market segments including economy, luxury, and performance consumers. This increased competition forces Tesla to continuously innovate while strategically adjusting pricing to maintain its market share. Tesla is facing competition regarding innovation, battery technology, and autonomous driving systems. Though the company has acted as a forerunner in these fields, the huge R&D investments from other automotive players are starting to level the playing field. Competitors are rapidly improving their battery efficiency and driving assistance function, which were once solely the selling points of Tesla. With other companies on its heels, Tesla must now balance maintaining its image of ultra-modern technology and coping with increasing safety-related concerns and regulatory scrutiny, particularly regarding its autopilot functions. Operational troubles have also added to the complexity of Tesla's market standing. The company has overcome the challenges of scale and supply chains to the point that it cannot meet its production targets quickly and deliver vehicles across a fast globalizing market in time. These disturbances in logistics and shortages in raw materials have come to aggravate the operational challenges, which in themselves are a consequence of macroeconomic fluctuations and trade policy impacts. Such operational challenges create vehicle delivery delays, reduce customer satisfaction, tarnish brand loyalty, and could severely impinge upon sales performance. Tesla's daring move into the geographical territories of Europe and Asia brings more complications. Each market is different with respect to regulatory frameworks, consumer preferences, and competition dynamics. For instance, in China, Tesla faces stiff competition from domestic manufacturers who enjoy substantial government support with the added edge of consumer nationalism. Setting configurations and navigation through the mix thus necessitates Tesla to customize its strategies significantly and invest heavily in local resources, stretching the company's already limited resources while exerting strain on its management. It will be the ability and willingness to adapt and innovate that will be most prominently seen as key to maintaining the upper hand for Tesla within the dynamic global EV industries as the company tries to work around these hurdles. The global backlash against Tesla, exacerbated by recent acts of vandalism, poses significant challenges to the brand's stability and reputation. In the US and abroad, Tesla vehicles have become targets of vandalism, largely driven by public discontent with CEO Elon Musk's political actions and the policies of his companies. This surge in vandalism not only impacts the physical safety of the vehicles but also leads to potential financial repercussions for owners. Insurance premiums for Tesla owners are already higher than average due to the sophisticated technology and costly repair expenses associated with Tesla cars. According to an insurance comparison by Insurify, a damaged Tesla costs about $1,300 more to repair than a gasoline-powered car, which could contribute to even higher premiums if vandalism becomes more widespread. The insurance implications of increased vandalism are complex and could affect Tesla owners differently depending on the severity and frequency of incidents. Shannon Martin from Bankrate suggests that while the immediate impact on insurance premiums may not be substantial, it is a growing concern that potential and existing Tesla owners should monitor. The trend of targeting Tesla vehicles as a form of protest against Musk's political affiliations could lead to a broader re-evaluation of risk by insurance companies, potentially driving up costs for comprehensive coverage specifically designed to cover non-collision damage such as vandalism. The public-mindedness about Tesla has changed, gradually shifting from the fact that the car was one presentation of innovation coupled with luxury to one amidst the contention of fiery political unrest and social distress. Incidents of vandalism, like burning a Tesla Cybertruck in Seattle, will heighten this tendency and further dissuade new customers from venturing into the scene or pushing current ones to examine their bond to the brand. Negative publicity and increased operating costs, like costs of insurance, are likely to rob the brand of its shine and hurt sales. The current situation presents a strategic management challenge for Tesla as the company's brand is associated with a controversial person, Elon Musk. The immediate concern lies in how to manage public relations and cover the financial burden of customers, which ensures possible change in its own insurance offerings. However, proper assessment of Tesla's response to the two issues will determine how well customer loyalty and brand reputation can hold amidst the increasing global discontent as well as financial implications related to it. The recent wave of insider selling at Tesla has raised serious concerns about the internal confidence in the company's future prospects. High-profile executives and board members, including Elon Musk's brother, Kimball Musk, and the CFO, Vibe of Takedown, have been selling off significant portions of their holdings. This trend of insider sales, detailed in various SEC filings, points to a potential lack of faith in the company's leadership and future market performance. Samuel O'Brien's report in Thou Street highlights that these insiders, including James Murdoch and Robin Denholm, are selling their shares amidst a backdrop of declining stock prices and growing uncertainty about Tesla's operational direction and leadership under Musk. The timing and volume of these sales are particularly telling. For instance, Kimball Musk offloaded 75,000 shares just as Tesla's stock experienced its largest single-day drop in 5 years, indicating a possible desire to minimize personal financial risk amid the company's fluctuating fortunes. This insider activity coincides with a broader trend of declining investor sentiment, as Tesla's stock continues to struggle despite Elon Musk's public reassurances about the company's innovative capabilities and future prospects. Analysts on the market and investors are glued to these insider movements as indicators of the internal well-being and future expectations of the firm. The perception of a loss of confidence by the insiders compounds negative sentiment among institutional investors and hedge funds, many of which have already begun scaling down positions in Tesla. Their retreat is reflected in the cautious, even bearish, stance from Wall Street, which has responded to both performance problems from Tesla and Musk's odd behavior affecting the confidence of investors in Tesla's brand. The trend of insider selling at Tesla indicates that there are deeper worries about the company's underpinnings and future growth. If the company's major people are preparing for possible downturns, it could indicate to the wider market that what faces Tesla as a challenge is pretty important and possibly long-term. Tesla needs to deal with these internal and external matters in an open manner, showing that the company has a clear plan to operational and financial viability, thus regaining investor confidence and stabilizing price stock. But as Tesla navigates these policy changes, are technological hurdles the next frontier challenging this EV giant's ambition for dominance? Tesla's journey in advancing automotive technology has encountered significant hurdles, particularly in the realms of battery technology and autonomous driving systems. Despite being a leader in electric vehicle innovation, Tesla has struggled with the scalability and reliability of its battery solutions. Issues such as battery life degradation, efficiency under various environmental conditions, and high production costs have posed ongoing challenges. These technological hurdles are critical as they directly impact the vehicle's performance, range, and consumer appeal, which are pivotal in maintaining Tesla's competitive edge in the electric vehicle market. Autonomous driving technology, marketed as autopilot and full self-driving, FSD, in Tesla's suite of offerings, has been another area of intense focus and considerable difficulty. While Elon Musk has frequently promised fully autonomous capabilities, the reality has often fallen short of these ambitious declarations. Regulatory scrutiny has intensified following incidents involving Tesla's autonomous systems, which have been linked to several accidents, some fatal. This scrutiny has led to investigations and growing skepticism about the safety and readiness of Tesla's technology for widespread consumer use. The engineering problems reach towards challenges posed to software and system integration. Tesla has now become an avant-garde company for over-the-air updates of vehicle software. This set a revolutionary tone in the automotive world. Engaging the entire software and control of all physical car functions under high reliability is an exceedingly complex problem. Owing to software reliability issues, coupled with sensor integration and data processing problems, recalls have been issued and safety concerns raised, affecting consumer trust and regulatory acceptance in such processes. This provides a glimpse into the conundrum of marrying cutting-edge technology with robust and fail-safe automotive standards faced by Tesla. While every such setback is amplified by public and media scrutiny, Tesla's aggression toward leadership in these territories has put them under a microscope. These technological hurdles thus require Tesla not only to innovate, but also to guarantee that their innovations are safe and reliable when executed at scale. How these matters are dealt with will be considered significant to the company's future, not merely as a car manufacturer, but as an automotive technology leader. Tesla must now reconcile its dream with an exercise in reasonable feasibility and then with rigorous testing to meet market expectations as well as regulatory requirements. Tesla, once a trailblazer in the electric vehicle (EV) sector, is encountering significant headwinds as it deals with plummeting sales amid a booming market for electric cars. Gabriel Holton of the Cooldown reports that Tesla sales in Europe have nearly halved compared to last year, a stark contrast to the overall European EV market, which has seen a growth of 34%. This decline is occurring in a period that otherwise shows promise for electric vehicles, indicating that Tesla's issues may be particularly pronounced and possibly linked to CEO Elon Musk's controversial political maneuvers. The falling sales are critical because they signal a potential shift in consumer confidence and the appeal of Tesla's brand, which could have broader implications for the resale value of its vehicles globally. As Tesla grapples with these challenges, the competition is not only catching up but in some instances, overtaking Tesla in terms of market innovation and growth. Established automotive giants and new entrants from China, like NIO and BYD, are quickly filling the gaps left by Tesla, offering advanced technology at more competitive prices, which appeals to a cost-conscious consumer base. In truth, the much broader overall growth in the electric vehicle market is still very healthy in itself, again further testifying to the lost opportunities for Tesla. Elsewhere, labeled increases in sales suggest that demand is still quite fierce for electric vehicles. In particular, it is becoming more and more evident that consumers are developing a taste for brands other than Tesla. For Tesla, this is extremely scary as it probably tells that the current turmoil is not just an unfortunate downturn, but a more grand indication of something fundamentally wrong in terms of market strategy and product appeal. As such, customers and investors are beginning to look into getting other EV alternatives that compare well or even better than those Tesla is known for without the encumbrance of the controversies surrounding Tesla lately. With the increasing diversification of the EV market, Tesla increasing cost to its dominance, and the need for the company to reevaluate its strategy for survival within the market demand, competition is creating it to be progressive. Tesla has to cope with these burning issues to make an impact and capitalize on the trend of increasing electric vehicle demand, with competition leveling innovations and expansions. The emergence of new electric car models from traditional automobile corporations is choking on the already congested competition that Tesla faces. Companies are not limited to just expanding their lineup of EVs. For example, brands such as Volkswagen and Ford have poured a lot into electrified utility vehicles, which have seen tremendous growth. One such example would be that of models such as Volkswagen's ID.4 and Ford's Mustang Mach-E, which have been favorably received in the market and are now competing directly with Tesla's Model Y feature by feature, dollar for dollar. These models enjoy benefits from their parent company's vast dealer systems and brand loyalty entrenchments that Tesla does not yet enjoy in many markets. This is further reconfiguring the terrain where Tesla once had a major upper hand, and it is innovating beyond its present offerings just to maintain its market share in the wake of this competition. Tesla's brand perception has undergone significant shifts, influenced largely by external pressures and internal actions by the company and its CEO, Elon Musk. Initially celebrated as a revolutionary force in the automotive industry, Tesla's allure was built on its commitment to innovation, sustainability, and the charismatic leadership of Musk. However, recent years have seen this perception become more nuanced and, in some cases, negatively affected. Controversies surrounding Musk's public statements and social media conduct, coupled with high-profile incidents involving Tesla vehicles, have led to a critical reassessment of the brand among consumers and stakeholders. The polarizing nature of Musk's political affiliations and social media antics has particularly impacted how progressive consumers, the core of Tesla's early adopter base, view the brand. These consumers, who often value corporate ethics and environmental responsibility, have expressed disillusionment with Musk's actions and how they might reflect on Tesla's corporate values. This growing disenchantment poses a risk to Tesla's brand loyalty and its image as a leader in sustainable transport, potentially alienating a significant segment of its customer base. Tesla's reputation has had to suffer some bruises when looking at safety and technology. The company's zest for quick innovation has sometimes exceeded its capacity to assure reliability and safety, resulting in publicized recalls and safety issues concerning its autopilot system. These issues have catapulted into the media limelight and raised questions before regulatory authorities, thus augmenting the widespread feeling that perhaps Tesla might be putting speed to market ahead of consumer safety. This state of affairs, if maintained, could dent the image of Tesla's cutting-edge technology and leadership in autonomous driving, which happens to be two major pillars of its brand identity. Nevertheless, Tesla holds strong to this day, particularly in its branding in the electric vehicle space, owing to its proven capability to innovate and to stretch the limits of what electric cars can achieve. In order to maintain and improve this brand perception, it must now adopt a strategy of directly confronting these concerns, putting its commitment to safety and consumer satisfaction on par with its innovations. Much of Tesla's ability to remain successful and lead the global transition to electric vehicles will depend on rebuilding and maintaining trust with its consumers, all the while managing the public relations fallout from Musk's high-profile presence. Wading through the challenges above, it might just be the larger cultural leaning towards sustainability and green technology that will make the critical difference in reshaping the given perception of the Tesla brand in a more favorable light. Awareness and worried demand for green technologies now reach dizzy heights. Pew Research Center discovered through a study that 71% of Americans believe personal actions can make a great deal of difference within climate change at present, 2021. Cultural waves could carry Tesla with them because the mission on which the company relies rests so much on these values. Even controversies don't dissolve the role of Tesla to push the auto industry toward electrification, with contributions that would continue to improve its sustainable ideals, such as the betterment of recycling processes for battery waste in its plants. Such an innovation matters societal value, making it possible for Tesla to change its image as an auto manufacturer rather than merely one of the world players in transitioning towards a sustainable future. Tesla's current financial strains highlight the significant challenges the company faces amid heightened market pressures and increasing competition within the electric vehicle (EV) industry. A recent focus has been on Tesla's PPE accounting, which pertains to the plant, property, and equipment line on its balance sheet, suggesting discrepancies in capital expenditure reporting. However, as Root from Barron points out, differences between reported capital spending and the gross PP&E figures are common across the industry and not necessarily indicative of a major issue within Tesla. In 2024, Tesla reported spending $11.3 billion on new PP&E but showed a $1.7 billion shortfall in the expected addition to the PP&E on the balance sheet, a variance that experts like Robert Willen suggest is not alarming but rather an expected part of financial accounting in capital-heavy industries. Despite reassurances about Tesla's accounting practices, the broader financial challenges for Tesla stem from several factors including aggressive expansion, intense global competition, and the capricious nature of market sentiments influenced by CEO Elon Musk's actions and statements. Tesla's aggressive investment in new technologies and expansion of manufacturing capabilities, while necessary to maintain its competitive edge, requires substantial capital outlays. These investments have placed additional pressure on Tesla's cash flow and profitability, particularly as the company strives to lower vehicle prices amidst growing competition from traditional automakers and emerging EV companies, especially in Asia. The performance of Tesla in the capital markets keeps being fickle because of the external part of the economics and, to some extent, effects inside the corporations. Outside the event of the new U.S. presidential inauguration, with a decline of 36% in the stock price, again, investors believe in and want Tesla to do well in the future under the current politics and economy. Tariff policies as well as world economy conditions influence in a healthy hunk of ways the investor sentiments about Tesla. At one point, the company had a string of good news which resulted in a 12% price rise of the stock on the market, but this should mean that in the long haul, the pressures would become even stiffer as company areas develop. Through improving strategic orientation and, of course, enhancing efficiency, Tesla can better manage these financial strains and improve the performance of its market. Fundamental stabilization in production costs, development of a streamlined supply chain, and innovative breakthroughs, such as into battery technology, as well as software for autonomous driving, prove crucial. In addition to that, a somewhat transparent and stable approach toward administration will also go far in stabilizing investor confidence. In these challenges, Tesla's ability to adapt successfully to the fast-changing automotive landscape will be an important determinant of its long-term success and sustainability in the global marketplace. The changing panorama of world energy policies brings in further complications in Tesla's financial conditions and market operations. On one hand, stricter emission regulations being implemented in many countries will promote Tesla's market for electric vehicles. On the other hand, they will provide support for new competitors getting local subsidies and regulatory backing. thus increasing competition. For example, the European Union has ramped up its carbon neutrality goals, leading to greater government incentives for EV manufacturers, consequently allowing more players in. Likewise, in the world's largest car market, China, the government's push for cleaner energy has met with large benefit plans for local EV manufacturers, putting pressure on Tesla's operations in the region. Navigating through financial turbulence, Tesla stands at a crossroads between market pressures and innovation. What lies ahead in its quest to redefine the future of transportation? Tesla's future outlook, while challenged by recent developments, remains robustly tied to its capacity for innovation and market adaptation. As the electric vehicle, EV, market continues to expand globally, Tesla's pioneering role in this sector provides a strong foundation for future growth. However, the company must navigate significant hurdles such as increasing competition, shifting consumer preferences, and the ongoing controversies surrounding CEO Elon Musk. To maintain its market leadership, Tesla will need to continue innovating while also refining its existing technologies, particularly around battery efficiency and autonomous driving capabilities, which are central to its brand promise. Financially, Tesla needs to strike a balance between aggressive growth and green sustainability. The company is investing in new production facilities, such as the ones in Berlin and Shanghai, in anticipation of an increase in global demand and a reduction in bottlenecks in production. These expansions prove to be costly and will heavily test the financial viability of the company. Controlling these costs while continuing to innovate in an ever-growing competitive market will be most vital. Financially, it may also have to bear the burden of lower government incentives or changes in regulations. Indeed, with the perennial challenges of distorting an image associated with the high-powered CEO, Tesla's brand management faced further public perception troubles. The company's image and consumer trust have been damaged by public relations issues accentuated by Musk's actions and utterances. If the brand is to steer itself toward growth, it should focus on corporate governance and transparency so that innovation and high quality of products remain associated with the brand rather than its executive controversies. This will further cement and enhance the growth of its emotionally viable customer population. In all probability, Tesla can sustain leadership in converting global transport to environmentally sustainable. Central to its strategy in harnessing technologies of the future would be to explore autonomous driving and improve renewable solutions. From the business point of view, the most important agenda is to overcome all the running inefficiencies in management that are externally pressed upon them and maintain a unification in pace for technical innovations corresponding to global changes in energy and transportation. Should Tesla succeed in such diversified arenas, such work will not only cement its current status, but it would also establish the standard for the automotive future.